Mortgage rates have risen since the start of the year, and analysts say homeowners should brace themselves for further increases. This report by Calvin Hui.
At the beginning of 2015, home buyers in Singapore could get loans that start at 1.6% in the first year. That rate has been creeping up, and the figure is now around 2%. Mortgage brokers say rates are likely to go up further, as recent increases in the 3-month Singapore Interbank Offered Rate, or SIBOR, a key benchmark used by banks when setting mortgages, have not been fully reflected in the interest rates homeowners are currently paying.
With the impending rise of the US Federal Reserve rates, SIBOR is definitely set to rise. Banks has used SIBOR or SOR rates as a reference when they do the mortgage interest rates, meaning to say they peg it to a public rate, and if the rates goes up or down, it will affect the mortgage interest rates that the borrowers have.
DBS expects SIBOR to rise to 1.22% by the end of this year and 1.75% in about a year's time. Should mortgages increase by the same amount, a family with an outstanding $500,000 mortgage spread over 20 years will have to pay an additional $140 a month to service the loan. Analysts say most homeowners can shoulder the burden. That's because banks must ensure borrowers can still service their home loans if interest rates rise to 3.5%. As for homeowners concerned about rising rates, one analyst says they should consider fixed-rate packages.
I think that really still boils down to what is your risk appetite and whether you think interest rates are going to go higher. Right now, there are two schools of thought. There are people who think that interest rates are going to shoot up over the next few months because of the expectation of the Fed raising the interest rate. So in that case, it would be better for them to go for a fixed loan package instead.
Financial markets have been volatile in recent months because of uncertainty about interest rates.